Well, hello, everyone. This is Michael Douville, and I have a very special guest. Charles Nenner is with us today, and I have lots and lots of questions for Charles. He has been forecasting, and his forecasts have just been coming true, and it's just been absolutely amazing. So, Charles, thank you so very much for sending out your research. It has been truly amazing.
I hope you guys can do something good with it because of difficult times.
Very difficult times. I have talked to my clients. We've talked about the bond market many, many times. We talked about the bond market, you and I, 2 years ago, and your call was just amazing. I had most of my clients out. We got a lot of mortgages too in our business because if it's not good for you to borrow money or to lend money, it's probably a good time for you to borrow. A lot of my clients, we did that. You've been talking about the fact that the U.S. dollar was going to go to 113 on the DXY. You've been saying that for a year. You sent out charts in August that you're forecasting to 113. Yesterday, it was 114 and change, and it's backing off a little bit today. Today's the 28th of September. Do you still think are you going to get higher targets for this, Charles?
Well, it depends on cycles that we use for the timing and price target. So I don't have a higher price target on 113. What you see here is a point and figure chart. And the cycle that brought all this dollar up is stopping by the end of the week. So there's a good chance that we did see the high for now and maybe the low in the euro. So for now, I don't have higher price targets than 113. And people who were long the dollar or dollar index took profit at around 113.
Well, I think we've talked about a long-term euro that's less than what it is the par. I think we talked sometime in the 80s or 90s on the DXY. Is that
I think the low was 95. But I have a very nice cycle top between now and the 3rd of October. So today's 28th, it's almost a weekend. So around here, the euro could finally see some strength. That corresponds with the cycle top in the dollar. So whoever now is coming in, the dollar goes much higher, is probably a bit late.
So one of my concerns, kind of as a layman looking at this, is that when you have a strong dollar, you have less inflation. So here we are in the U.S., we've got a really, really strong dollar. I'm going to say 113, 114 is a pretty strong dollar. And our inflation is running about 8.2. We've had some headline inflations at 12. I haven't been able to confirm that. But then when you look at places like Turkey, and I'm going to pick on Turkey here because, 20 years ago, the Turkish lira was par with the United States. And now it's just collapsed. I think it's their currency is really, really down. And I think their inflation is running close to 80%. Is that not true?
Yeah, but talking about United States and Europe, based on cycles, we should see some lower inflation now for a couple of months. So just when everybody is getting out of his mind because the inflation is high, of course, it always happens like that, then you have a top in inflation again. It's not over longer term, but short term, it's not going higher. It should go lower and probably going to be surprised on the downside in the next number, which will correspond with an important low in the bond market.
So we've been talking about this. You and I have been talking about this for a long time. That we thought inflation was going to be mitigating. It was on your charts. You could see it. You could see it in the charts as well, just on price charts. And you could see that a lot of things were trending down, and the economy was really slowing down. So long term, when we have a long dollar like this, what should we be doing if we want to protect ourselves, say, a year out from now? Because
in the dollar?
Well, just as a layperson, it would seem that if the U.S. dollar is strong, then maybe we should be buying foreign assets. Should we be buying gold at this point, or we should be buying like Australian bonds? Or
well, as you know, based on cycles and price targets, maybe remember we had a downside price target on gold of 1646. You remember? It looked very far at that time. It was about $300 down when we wrote it, but we hit 1646. The cycle is still down, but if we don't go below 1646 much, then we soon in a couple of weeks should start to rally. The only caveat is if we really get below 1646, we can go as low as 1500. So we're just waiting for the cycle to bottom. We have three recommendations for our clients. That is, as you remember, we have been in zero stocks since last year. And today we covered all the shorts that we sent out today. We covered all the shorts. We had a price target, for instance, on the S&P of 3620 that was hit. And there's a cycle low, short-term cycle low coming up, and expecting the tradable low in the market, followed by, in a couple of weeks, a tradable low in the bond market, followed by a tradable low in the metal. So there's a lot of cash we're going to put to work. But again, the best is to watch our cycle work. As you know, you can get it for free for 30 days. And then you'll be right on top when the cycles bottom and when it's time to buy. But we're putting some cash to work over here.
Well, I have learned, and by following your research for a number of years, that these entry points that you give are pretty stunning. I just want to come back to this dollar, because it seems to me this dollar might be tied to inflation. So the stronger your currency, the lower your inflation. I'm just concerned that as the U.S. dollar cycles down, because obviously we're not going to stay at the high forever, that if this dollar cycles down, it's going to cause long-term inflation for us here in the United States, like it's happening in Turkey. Turkey, of course, is an extreme case, and Venezuela and places. I don't see us doing that. But I know you have inflation on your charts. Do you think as the dollar comes down that we're going to start seeing more inflation here in the United States?
Well, as you maybe remember, I don't make combinations. I look at every asset separately because one can make a mistake approaching this from a fundamentally point of view. The cycles on the commodities is down for a couple of months, and the dollar cycle short term is stopping. That's what I can say. If it's connected or not, I guess economists can say it's connected. But that's not so important because, as you know, we deal with what's going to happen and when it's going to happen, and not why it's going to happen. I leave that up for the other experts.
Yes, you do, and you do very well. Let me go to our next slide here, Charles, because we're talking about exactly what you've been talking about. You've been sending this chart out. I have to tell you, you probably know it's in all the news that the Bank of England threw in the towel this morning, and they're starting to buy bonds again. And you've been sending this chart out saying that I believe it's here. September 30th was going to be the peak in the 10-year. Here it is, the 28th, and we're starting to get the 10 years already starting to back up a little bit. So this is for a little while. This lower section here where your dotted line is, we've got 3 or 4 months, 5 months of lower interest rates coming at us.
Yes. I'm still working on it because the 30-year needs another couple of weeks for the rates to top. And the 2-year is down into middle of November. So I have to match those things. But we give the levels where the sell signal is canceled and it's still on the sell signal. I don't remember. I think 110.24. If the 10-year closes above that, then the sell signal is canceled.
Yeah, you've been sending it out. I don't recall myself. I'm just trying. I have clients. We're trying to we're trying to get as better rates as we possibly can. We want to refinance and buy some properties, and of course, this looks like it's going to give us a window to do that, and it looks like it's going to be a few months longer. Let me go to my next chart because this one's really, really interesting. This is the 2-year note, and this is me putting in it exactly what you're talking about. The 18th of November is your date. And that's where I put this red marker. Is that where the Fed's going to stop raising rates, or is it just a pause, Charles? Do you think?
No, because I've been sending out the Fed funds cycle, and it's down. That means the Fed funds are up until late 2024. But there could be a lull. So you have a bounce over here. But by the way, I also looked at the recessions cycle, and we should have a recession until the end of 2024 at least.
Well, this will certainly do that. I guess this is me hoping that we were going to see the ending of the Federal Reserve. So this is just a bounce that we're looking at. Is that correct?
Right.
Well, then, so the advice probably is that if you've got any refinance to do or you've got any bonds that are in your portfolio, you really need to talk to your financial advisor and start thinking that this is time to get rid of those things. Is that correct?
Yeah, we just bought some 2-year notes today with, I think the yield was like 4.5% or so. It gives you something against the inflation. I thought it was, I'm not going to wait for the last ticks, but I thought it was a nice return.
Well, 4.5% is right. You probably pick up a point or two on capital gains with that as well. But again, let me just reiterate. This goes into 2023. So is this looking maybe 4, 5, 6 months out? We have a little bubble for at least a little bit of time.
Yeah, but you see, it doesn't look much like a spike. It looks like going slowly up and then horizontal. So
Yeah.
probably we're not going to see a lot of price action.
Well, at least it stopped going up, because that's certainly a help. But again, so you really have to pay attention. This is not a market that you can just say, well, okay, I'm just going to buy and hold and forget about this. This is something that you have to really pay attention to what you're doing.
But the interesting thing is, and I always try to get it across, that these models that I wrote don't really know what's going to happen a year in advance, and still the cycles know what the assets are going to do. So that's why I always try to educate people. You want to know what your assets is going to do, and forget about the news and why it happens, because it could be, it could not be, but by the time you understand why it happens, it's already too late.
Well, your advice has been absolutely impeccable. So I've passed that along to several of my clients. So let me go to the next slide. This is exactly what you were talking about, because you and I had some private conversations about this. And I get this. This is from Zero Hedge. I just picked this up actually just yesterday, and it's just stunning. We have, for the very, very first time in 10.5 years here in the United States, we actually had a home price decline. And if you look at this green bubble, I don't know if my cursor is getting recorded, but this green price increase really corresponds to that $10 trillion of stimulus that we put in. They almost look identical. And then, of course, the stimulus is gone, and look what happens. We get a decline. Do you think we're going to have more price declines? Have you looked at any of our housing at all?
Yeah, I looked at the Toll Brothers and Lennar, and they're short-term buy, so probably will stabilize over here. But I did cycles on housing sales, and they're down also until the end of 24. It doesn't mean that's the end. Could be that there's a bounce after 24, but at least they're under pressure until the end of 2024.
And it's home prices, or is this for new construction?
It's new home sales.
So, sometimes in my business, we make a differential between new home sales and existing home sales, because new home sales, of course, is a business. They're bringing supply, and they've got a lot of different things that home buyers don't have. So I often wonder what they're much more economically sensitive than an existing home buyer. So let me just look at this one. So home price is going to get a bounce, probably corresponding to the fact we're going to get some a little backup in interest rates, I guess, because we're very interest rate sensitive. So,
probably, but again, I don't combine it. It's not, a lot of money has been destroyed by people who were long silver, gold, who were long the bonds, who were long the stocks. So it can't be that these housing prices are keeping their levels. It's impossible.
Well, I think we have a couple things. We have demand going, but also people have to have an affordability. So if you can't afford it, you can't buy it. That's just the way that works. I mean, that's been like that for a very long time.
Yeah.
So here it is in lumber, and of course this follows again. Charles, your charts were just absolutely amazing. You can see the bubble. This corresponds to that last chart we had. You can see that big spikes in lumber, and then it drops down. So here again, so your lumber, this goes again what you're talking about with the fact that you're showing that we're going to have a little bit of backup in rates, and that you think that Lennar and Toll Brothers are going to pick up, because you've got them. Looks like we've got a bounce and then a level off. So it's not like a spike.
Right.
But it looks like first of the year we're going to get a little better marketplace for new homes and probably existing homes. Would you say that's probably true?
Again, that's above my head. That's not my expertise. I just stay with what I know, and I don't talk about what I don't know.
Well, we've got lumber. Looks like it's bottoming first part of 23, and then we get a little bit of improvement in price. Would you say
No,
that's probably?
actually, the short-term cycle is bottoming right here.
Oh,
This is a weekly cycle, but the short-term, we had a long-term downside price target of 436, and that's where we covered the short. We hit that, and the short-term cycle is very close to a low.
so if you're going to build a new house, this would be a great time for you to start thinking that you want to get your supplies in, I would guess.
Yes.
Huh?
Yeah.
Well, that's wonderful. Good. See, now that's so helpful to a lot of people. Let me go to our
That
next
much
slide.
I understand.
Yeah. Well, it takes me a while to do this. I have a saying, Charles, and not to flatter you, but when Charles Nenner speaks, it really pays attention. As always, you're better off listening to what you have to say. Let me go to my next slide. Let's just talk about that. Here's the Dow Jones Weekly, and this is one heck of a chart. So I don't really understand. There's an awful lot of it. Looks like it's pretty choppy. Would you say that's a choppy chart?
Well, this is an old chart. I don't know when it was published, but it showed a tradable low the 7th of October, and we still think that is an important date.
So this is
I mean, this was a bounce. Right now we're let me take a look here. I see the bounce was around 33,000. Now we're 29,000. So it came down right into a cycle low. So the cycles projected that this bounce wasn't for real and had to go lower. And we have to take another look. But it's very possible that there'll be a tradable low after the first week of October.
So it looks like all these cycles are pointing that we're going to get an improvement in markets, both in the stock market, the commodities. Looks like lumber is coming up. So it's amazing how if you look at all these, you can kind of put them together and see how things are coming. Now here's your Fang index. Now this looks like it's a pretty good chart, Charles. Now this is your chart, so I don't want to talk about it. Once you talk about that, this looks like it's actually going nicely. Is this tradable?
Yeah, there's a Fang future, but you can take the Fang stocks and only buy stocks like Microsoft and Apple and those stocks, Netflix, and then copy the Fang index. But there is a future. It's not very liquid.
But this is a pretty good indicator of the marketplace, I would think. That these guys are the leaders in the stock market, are they not?
Well, maybe not anymore.
Not as much.
Ask Katie. What's her name? I forgot.
Yeah, with ARK. Is that? Yeah. She's that's true. That's too bad. But it does look like it's going to get an improvement in price. Is what I'm looking at.
Yeah, this looks also we could have a bounce into beginning of next year.
So we've got a bounce. A lot of people have really lost a lot of funds in the last quarter for sure. I guess this is like one of the worst stock and bond markets for 100 years in the last 6 months. So maybe this is an opportunity for them to recover and maybe reallocate their portfolio. Would you think?
The problem is that we're still under influence of media and the pundits who think they know what's happening. And I warn all the time that now, if you look at all the bear markets of the last 200 years, it's very normal to get a bounce of 15 to 18%. And then everybody's going to shout the bear market is over. And then people, instead of rescuing some of the money, put some more money to work because they think, oh, it's all over. And then the whole thing crashes again. So I have to warn for this. As you maybe remember, we got out of 30-year bonds when they're around 190. Now they're right around 125, but there were all kinds of bounces in between. And that sucked people in all the time because they thought it was a low. You cannot go against the cycles. The longer cycles are still down. And if I'm correct, and you're going to see a tradable low in October, so I also assume I'm correct that it's not the end of the down move.
Well, if you talk about history, you can go back and look at the Great Depression, and there were some pretty sizable up and downs. There were some pretty sizable bounces. It looked like it was over, but it wasn't over.
The same thing in the bear market from 2000 and the bear market from 2008 and the bear market from 1998. Most investors are now too young to know the history, so maybe they should look up a history book how bear markets develop. because they probably never saw a bear market in their life. That was our discussion 2 years ago or so in the bond market. I says there have been 40 years of bull market, and people think it's going to continue forever because they have never seen a bear market, but it's almost over, and you better get out of bonds.
Well, we talked about that. We talked about the implications for the pension funds, particularly for Europe, because there's an awful lot of zero and sub-zero bonds in these pension funds, and of course,
Amazing.
interest rates go up, they're just going to destroy that bond portfolio.
Yeah.
So, and this has implications for a lot of people my age and your age that that they're counting on these funds to be there, and of course these funds are really, really under pressure. Would you not agree?
Yeah, but it's amazing that people thought that bonds gave 1% interest, and they thought it will always be there forever. It's just you have to put a minimum of work a day or a week to understand financial markets. It pays off, but you have to get some understanding.
Yes, you have to do it yourself. I do a seminar here. It's called "You're on Your Own," and I think for the most part people are on their own. I have an awful lot of clients that come in; they're just absolutely amazed at how bad their finances are, and they've been counting on other people to do things for them, and other people let you down. So I agree with you 100%. So I'm really concerned what's going to happen in Europe, because there's an awful lot of Europeans that have these pensions coming, and
but remember one thing. So I'm Dutch. So if the Dutch government issues bonds, almost 100% is taken up by the Dutch citizens, and if the Americans do it, it's almost 20% of the U.S. citizens. They depend on foreign markets, the Chinese and who knows what. So they're much more vulnerable than the Europeans. That's the other side of the coin.
Yeah, it's going to be really interesting, isn't it? So it's the next year and a half. It's going to be very, very interesting. Let me go to my next slide if I can here. Let's just take a look at it. So here's copper. Now this is the tell for what we're talking about. Here's why I 100% agree with you that the downturn is certainly not over in the economy. Look at this chart. Even I can read this chart, because this is Dr. Copper, which is used all across the world. I mean, this is the greatest indicator you can have, and you've got it going down, don't you?
Well, I got them close to a low, and then a move up, like the other markets, and then it continues down into 2025, which just confirms the recession. Interesting thing is that cycle stopped a long time ago on copper, and only now we're talking about the recession. So it's still a kind of a mystery what's going on with this cycle work. Are there insiders who do know what's coming and they're much better? That's why the cycles work, but I don't know for sure. But if you look at the highs and the lows, if you would have sold at the highs and covered soon at the lows here, you actually would have predicted what happens in the economy also.
Mm-hmm. Do you have anything that looks beyond 2024? Because this is what you're saying. It starts to pick up to 2024, and you can see in copper. This is just what we were talking about. That little bounce that comes in. It looks like your dotted line is the bottom in copper prices, and then it pops up again for a little bit.
Yeah,
and that would probably coincide with that time frame we've been talking about with better stock market, better bonds, and then down it goes again.
Yeah.
Do you have anything that goes up beyond 2024? Does it start to improve at that?
I don't know. I also have quarterly cycles and yearly cycles, but they're not very good for. They work perfectly, but you don't have much help for investing if you know that the top is the next 2 years. So I don't publish them, but I have them, but I don't know what they look like.
Okay. Well, let's go to my very next slide, because I think it follows right along with what we're talking about. I also got this from Zero Hedge just the other day. It's just, these are amazing charts. And this is coming out of the Dallas Fed. And of course, here in the United States, we have different federal districts. This is Dallas. Dallas is pretty active. It's one of the greatest housing markets in the United States. It's a big manufacturing center in the United States. And just as what you've been saying is that we have got in the last quarter, we have gone negative. So in Dallas, it would certainly look like Dallas is in recessionary territory and continues to do so. This is just a very, very recent chart. You just got this a couple days ago and continues down. So,
yeah, like I said, my work sees the recession until late 2024. So this corresponds with what's going on over here.
yes, perfectly. It's just perfect confirmation. It's just absolutely absolutely amazing. You've been saying this. You know what's even more remarkable, Charles, is that you've been saying this for. You and I chatted last year. We were talking about this. It's been truly amazing. Let me go to my next chart. This is crude oil again. Kudos to you because we're down. Oil is down pretty significantly. You've got it to 21st of October. It looks like it's going to be pretty close to the bottom in crude again, and it looks like it spikes up again, huh?
Right. So the interesting thing is, what is moving crude? How does the computer know if crude goes up and down? Does it have anything to do with Putin or the wars? Obviously not, because my computer doesn't know that there's going to be a war in Ukraine, or it's not going to be a war in Ukraine, or Ukraine is winning, or whatever. So again, I always stress people, if you spend your time on looking how markets work instead of listening to the news, you do much better.
Yeah, so something is going to happen. We've got much higher prices. It looks like it. So can we tell, are the oil going to go back to where they were? Do you think, Charles?
The problem for next year is that I do this war cycle, so we predicted this war already a couple of years ago, and the middle of now it's kind of neutral, but the middle of next year there's going to be another spike in war cycles, and we have the bond market going up, we have the metals going up, so bad things could happen, and the crude goes up. So you can imagine what we're going to see.
So speaking of your war cycle, have you? Is this imminent? I mean, we've been talking about this for many, many years as to what's going to happen with this. Does it look like we're going to settle this thing in the Ukraine at all?
No, the only thing the war cycle shows is going to be kind of neutral till the end of the year, and then the middle of next year, something big is going to happen.
Huh. And that maybe is corresponding to the spike in crude. I'm going to guess.
And the spike and the lower, the rush into U.S. bonds and the rush into gold and silver, it all comes together.
It all comes together, Charles. It all comes together. So, of course, people are going to safety. They're going to safe havens, and that would be U.S. dollar, I guess, U.S. bonds, gold, crude. We're starting to see European and Asian money coming here to the United States. I'm in the real estate business, and of course, we're seeing people buying homes here and receiving U.S. dollars as currency. So that would probably go right along with that same type of people moving to safety. I'm going to think, huh?
Well, I'm afraid that the United States is going to be in a big trouble, and it's not the place to be.
Do you have a better place?
Well, as you know, I'm in Israel, and Israel, you don't realize, is a very safe place. For instance, Israel has the area totally covered against incoming rockets, and my wife, as you know, is from Brazil, and I think Brazil is kind of out of the way if it gets too crazy, because who would look for Brazil, to do anything over there? So I have two options.
Well, they're good options. We're here in the Southwest, so hopefully, but we'll chat about this later on. You and I will do.
Yeah, we don't want to take the sleep away from people.
No, let's make a little money here in the next quarter or so. Let me go to my next slide. Again, this is wheat, so we're looking like probably we've had the bottom of food prices. Would you say?
Not yet, almost. As you see before, that's very interesting. We had a big spike up in wheat on the cycle, and that was one of the reasons that we were almost sure that there will be a war between Ukraine and Russia, because that could explain why wheat prices would go up. So it's not, you have to change around the cause and result. That means it's not because of the war that wheat prices go up. No, wheat prices have to go up, and that's probably going to bring out the war. So now they're still under pressure, but they're close to a weekly low. You're correct.
And it's a
So
probably be a little bit of lag as it goes through the producer price index and then into the manufacturing. But that doesn't last very long. It looks like it only lasts for a very, very short time. Then the prices spike up again.
yeah, but as you
So
know, we have our daily updates, we have our intraday updates. The cycles work good, but the price targets work even better. So we know exactly when to give us a buy signal, and we know how high it's going if it goes up. And based on cycles, we know how long it's going up. So it's very simple. We don't have to anticipate anything. We just wait for the computer to tell us what's going to happen.
So we as lay people, we should probably be looking to, this is probably going to be a low in some food. Maybe we should start stocking up. And of course, if you were a manufacturer, you'd be buying your wheat, wouldn't you? If you made bread, you'd be buying your wheat now, I would guess.
Well, you have the same problem with the live cattle, the McDonald's of this world, and the cocoa prices and the sugar prices. Whoever makes chocolate, grain prices. It's a whole system that we support. All these firms, so they know when to buy and when not to buy.
Well, it's made a believer out of me, Charles. So I'm really impressed with you. Let me go to the next one. This is an older chart. You've been talking about getting down to I think you had like a 65,
64.
64 was the target for Australian dollar.
Yeah, and I wrote if it goes below 63, we get a lower price target, and the cycles are still down, which corresponds with the gold prices and the recession. Australian dollar is very much influenced by the strength in the economy and by gold prices.
So this is a pretty telling chart. Looks like it's trailing off out to 24. So their dollar's under pressure for another almost 2 years.
Yeah.
Wow. Well, do you think? I suppose that would just follow with some inflation probably going to happen in Australia. Well, that's really interesting. It's been very, very accurate, and I just have Australian friends, so I'm really curious about that. I might go to my next slide. Now, here is what you've been talking about with Newmont Mine. I know that you like Newmont, so here's an opportunity maybe for people to get involved if they're going to do anything.
Yeah, as you see, the bottom was almost 2 weeks ago, and I wrote I don't think that gold is finished going down. Since then, it went down $80 or $70, and gold and Newmont mining is still at the same level. So I said, let's take a small long position in gold and mining just based on the cycles.
So a layperson would probably just, if you were going to invest 100%, maybe invest 10, 20% now.
Yeah, because you also get some dividend, and then wait for my buy signal on gold, and then you can add the rest.
And this looks like it's got a pretty long chart on this. I know you've been talking about gold going up to 2,500. Has that changed at all?
Yeah, no. It should go up to 2027 and go at least to 2,500.
So this would be something like Newmont Mine that pays a dividend. I think your junior gold miners pays a dividend as well to GDXJ.
Yeah, but they're still on a sell signal. We're still short over there. Again, I hate saying these things because then people do it, and if there's any change, you don't know. So I like them to look at the website again. We don't charge them for the first 30 days, and it's a very volatile time. And take a look how we do it, and at least you see what the possibilities are in the investment world.
Well, this looks like it's a trade. Even I'm not a stock guy. I understand some of it. There's certainly nothing like you do, but and this looks like something that would be an opportunity for someone. But let's just talk about your newsletter for a minute. You send that to me. It's just been absolutely outstanding. It's just been really, really. I love getting it. So you're going to allow someone to go 30 days and get do they get all the? What do they get for that free trial period?
They get 3 times a week. They get a daily update on gold, silver, most of the currencies, S&P, Nasdaq, European markets, crude oil, natural gas, etc. We trade a lot of USO and UNG. And Sunday, they get these kinds of graphs. So I show them what the computer shows, and they can see for themselves what the cycle looks like. And I think also I have to ask, they also get intraday? On the trial, they get intraday? And they also get intraday. So what intraday is that it tells you during the day where the low is and where the high is.
Well,
busy.
I would say, I think let me just go to my next slide, because I think that's your, is this still good? CharlesNenner.com? Is that where they go? I know up
Yep.
here you got a little free trial.
That's still where to go.
Well, I think that if you're looking and you're having any kind of issues with any of your portfolio, because you cover so many asset classes, that I think it'd be certainly to their advantage to go ahead and do this. It's just wonderful. I certainly enjoy getting it. Charles, we've covered a lot of territory today. This was a lot of questions. Is there anything else that you'd like to bring up? Anything that's been on your mind?
I'd just like to bring up that if you go to the trial, go to the introduction that explains how to read the charts and how the system works. It says, yeah, it values more than if you understand it.
Yeah, it takes a little getting used to understand it, but it's been very accurate. Any asset classes that you want to talk about? Anything that's happening in the world that you want to talk about before we end?
No, like I said, I expect the tradable low soon coming in the stock market, a little bit later in the bond market and in the gold market. So I think we're not 100% cash because we've got Newmont mining, and we have some shorts on UNG and USO. But for the rest, everything is in cash. So we're going to finally put some cash to work. And what is it? The Nasdaq was down 35%. So far so good. And now we're going to play the bounce. Again, I like people to watch exactly the price levels and the short-term cycle signals, so they're not going to miss anything. And then don't think it's over. Even if it goes up 15%, it's going to come down again.
And that's probably first, second quarter next year. We're good, and then, but we really need to pay attention to what's going on. I'm going to guess.
Yeah, don't think it's over because of a nice bounce, and don't listen to people say, "Oh, the bear market is over," because it's not. And if you want to Google, you can do Google. Maybe find a chart of the downturn of 2008, 2000, 1998. Then you see how many bounces of 15 to 20% there are, and then it goes down another 40, 50% again.
Well, Charles, this has been absolutely outstanding information. Thank you so very much for sharing with us. My very, very best to you. And thank you so very much for being with us today.